Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of LME 3-month lead and tin.
LME 3-month lead. In early June we saw a drop here down to the support in dark green, currently at 1968, of the lower trend line of the oft-highlighted November 2022 to May 23 broken descending wedge pattern. The upper trend line is further down in bright red, currently at 1896. 13 weeks ago I said at the time about this pattern, I quote, "The optimization I've undertaken makes me suspicious about the veracity of this possible pattern, but I'd rather say it and only look a fool now than have it confirmed later on." End of quote. Thus, this descending wedge pattern has been a combination of a conundrum, a disappointment, and even a bemusement since March. You see, the market exited out this optimized descending wedge pattern back in mid-March on the upside and proceeded then to do, well, nothing. For such a long time, we did not have the moves higher for a descending wedge pattern. What we did have is a more or less sideways movement from late March through to the middle of May, with prices capped by layered resistances and sustained by layered supports below the market. On the top side, we have resistance from the overhead 50% Fibonacci line of the March 2020 to March 2022 move at 2135, and in the past the declining medium moving average, currently 2104, and to a lesser extent by the declining short medium moving average, currently 2098. In more recent days, the move below the slowly rising long moving average, currently 2085, seen in the middle of May, then in early June, below the Fibonacci and other congestion at 2058 and 2039, that last one being the January 2020 high, and it started to look like the market might be trying on the downside after all. However, that drop to the green trend line in early June set off a move higher up through all the moving averages, and a test up to the key 50% Fibonacci line of the March 2020 to March 22 move at 2135. Part of this, I suspect, has been due to the close proximity of all the moving averages. At this time, the moving averages are actually between 2070 and 2104, an extraordinary narrow range. By the way, this has not happened suddenly just now. It has been like this for many months. You'd think being so close together they would reinforce each other. Yet the opposite seems true, as they were moving into actually a no man's land between support at 2058 and resistance at 2112. Hence, devoid of anything else to latch onto, the market went straight up through them. Why we now have seemingly hesitated at these levels is thus due to the resistances, other than moving averages, appearing at 2112, 2135, and then the 2150 area. That's from April time. And perhaps most importantly of all, the lower trendline extension of the May to June 2021 descending triangle, currently 2179. This is highlighted in purple on my daily chart. Only on confirmed closes over this last resistance would I even look at placing any targets topside from the old descending wedge pattern. Otherwise, we will have to see how good the moving averages are as supports, because they were recently pretty useless as resistances. Finally, still overshadowing all of this is January's monthly key reversal down. LME 3-month tin. The most obvious feature we now have here is the late October 2022 to mid-March 2023 bullish shift pitchfork, which is highlighted in dark blue on my daily chart. I drew this back at the end of April and going into May, and despite attempts lower, it still gives the main bullish angle of attack of this market. We're currently in between the lower time below, currently 24,340, and the middle time above, currently 30,665. So at this point, I'd like to draw your attention to the moving averages. They had in recent weeks been affecting the operations daily of this market. I first drew your attention to the long moving average below, currently at 24,105. You see, below the market, we have a series of stratified supports that slowed and eventually halted the market's attempts lower. The significant ones were and still are at the following levels: the 2013 high at 25,250, then between 23,000 to 24,155, then at 21,360, and between 20,435 to 25,10. Into these back in late March entered the flatlining long moving average to reinforce them, which it has done admirably. On top of that, the lower tine has been traversing these supports, and 2 weeks ago it crossed up over the long moving average, thus reinforcing the support even more. Meanwhile, closer in, we had the 2012 high at 25,875, interfering with recent moves higher, assisted by the ever so slowly dipping medium moving average, currently at 25,770. Last week, the two were breached and indeed broken. This led me last week to look higher at the lesser Fibonacci lines at 26,825 and 27,330, the latter being tested at the end of last week and then again this week. However, the next real resistance is up at the July 2011 high at 29,005. Even then, that July 2011 high is not that strong a resistance, and you would have to look higher still past the lesser Fibonacci line at 30,205 and towards the interesting 50% Fibonacci line of the March 2020 to March 2022 move at 31,845. So, overall, the market has moved upwards in between the middle time overhead, currently at 30,665, and the lower time below, currently at 24,340. And that's of the big bullish shift pitchfork, which is still running the market. Yet, after all this time, the action since January and its general shape prompted me 4 weeks ago to ask a simple question. Is the action since the height of January a possible very large bearish half hesitation in the making? I kept responding to myself, oh, it's too early, and it was just an idea. However, as I've repeatedly said, we have a lot of congestion both below and above the market, and thus I'm inclined to retire this idea and see what else the market brings.
Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.